Are you potentially overlooking your biggest and best retirement asset?
Joyce Palmer provides wisdom on wealth, empowering women to be proactive and make safe, smart, and simple financial decisions. Welcome to Proactive Woman, helping create financial legacies for ladies. Oh, and men too.
You're listening to the Proactive Women podcast, and my clients know that I'm available to answer questions and at a phone call or email. But a lot of times I hear that people have friends, coworkers, family members that don't have a trusted financial resource. So we extend Ask Me Anything. So you can call, you can schedule a calendar appointment, ask me any question. And it could be anything from what to do with my 401k, or I need Medicare, or what we're talking about today. How do I get more information on how to use housing wealth? Mm-hmm. What's a good way that I can leverage my housing wealth in my plan? So you can call and ask me any question. It is no cost. It's no obligation. It's just an opportunity to get your question answered. So I look forward to hearing from you and on that call or through a calendar link. So we said this was a 2 parts. So Don, this is amazing. Great information. I'm learning so much, and I took a bunch of notes. I want to kind of get an understanding exactly the mechanics of how this using housing wealth, reverse mortgage, really works. And if I'm doing retirement planning, how would I fit this into my plan? How does a possible scenario look for me?
Sure. And let me say something before I say that. I teach for the American College, and in there I've trained now close to 23,000 financial advisors about using and incorporating housing wealth. And my own 22 years, I've been 22 years doing this. This is all I do. And I want to say JP Financial, I make time for them. If you're listening and you're watching this, a lot of advisors are product driven. They're not best interest driven. They want to get you into some sort of, they're not comprehensive. And Joyce and Jerome look at the whole picture. They don't make anything on the reverse mortgages. They don't receive a fee or a commission. If they believe that doing a housing wealth assessment is going to strengthen your retirement income plan, then they'll connect with our team to do that. And if they don't, they won't talk about it. I love that. And so here in there are 17 advisors I have in North Carolina. When I came down here, I said, I want to see one. I just want to see one. And I just want to thank you for caring so much about your clients, and particularly women. Women in retirement is a particular challenge. So thank you about that. And so as we talk about strategic uses of housing wealth, I want to cover some things, and we'll have something on the screen here, I think, and that as we talk, you'll be able to see some things. And so I just wanted to pick up. Let me say that there's an article here in mid 2022. Yahoo Finance. It was a great article, and it said 14 key signs that you're going to run out of money in retirement.
Oh, wow.
14 key signs. Now, I saw that, and I said, housing wealth can address 13 of those 14, and I don't think most people know that. And so we're going to put that on the screen, I hope. And I want to talk about some strategic uses, things that come up often and common, but you lead the way.
Okay. Yeah. 14 key signs you're going to run out of money. The first thing, obviously, that's the scariest thing. And most my retirees, when they come in to the office and we sit down and start having our conversation, the first thing is, what's one of your biggest concerns? And that's running out of money, living too long. And this is an interesting story. I was talking with one of my family members, friend of my family, she used to come and visit with my mom, my late mom, before she passed.
Mm-hmm.
And they would sit around and they would talk, and mostly they would watch Family Feud and brag about their grandkids and talk about recipes. But they would spend time together. So this lady, she's in her late 80s and well established and accomplished and has achieved a lot of successes in her life. So I was talking to her and I said, you've had a lot of major accomplishments and got a lot done. I'm curious, do you have any regrets? And she kind of looked, a little sad, kind of distant. And she said, you're right. I've seen a lot. I've done a lot in my 80 some years. And the only regret I think I have is living too long. And I kind of paused and I took a step back, and she said, because I'm afraid I might be running out of money. And that really just took my breath away, because I don't want anyone that I'm working with to be in their late 80s and feel like their biggest regret is they're living too long because they're running out of money. So when you say running out of money, and if there's any way that we can avoid that or help, hedge that off, that's what we want to do for our clients. We want to make sure we're using every possible means to avoid that. So how does a reverse mortgage help them to avoid running out of money?
So if you're listening, that's a great question. So if you're listening, and I don't know what segment this may be in, but a reverse mortgage is a federally insured loan for those age 62 or better. Only one spouse has to be 62. So the other one only has to be age 18.
Okay.
Now, Alabama wanted 14, but Congress shut that down.
62 and 18. Okay.
And so now it's going to allow you to borrow money from your home, a home equity loan, home equity line of credit, without giving up ownership, coming off title, or making a mandatory loan payment. That's the basics of a reverse mortgage. Now, the amount of money you get, I want you to draw a triangle. And here's how we being the federal government, determines the amount of money. Number one, it's based off the age of the youngest borrower.
Okay.
Number two, it's based off the value of your home. Number three, it's based off of the interest rate, or what we call the expected interest rate. That's going to make a certain amount of money available in the middle of your triangle. Don, how much? Well, that changes every Tuesday. But a 70-year-old today, is probably getting about 50% of their home's value, something like that. So let's say what's a good home value? Just around
wow, here, Charlotte's home values are increasing so much. I would say easily 400,000.
Okay.
Easily.
All right.
Yeah.
So let me just use 500,000.
Okay.
And a 70-year-old can get 50% of that, thereabouts. So that's 250,000. So write that in the middle of your triangle, $250,000. Now that money currently is going to grow in that line of credit. If you say, Don, now you've liquidated $250,000, and it's growing today at about 5% tax-free. So now, and that may be on the screen. I think on the screen we'll have $224,000, and you'll notice it's growing. A reverse mortgage line of credit is a growing line of credit. It cannot be frozen, capped, canceled, or reduced because of economic factors. Most people didn't know your home equity line of credit, the bank at any point can say you don't have it anymore, you don't have as much, or you got to give it all back.
Yeah.
They can do that. And the federally insured home equity conversion mortgage, the line of credit, cannot be frozen, capped, canceled, or reduced. And it's a growing line of credit. So think about that. Now, all of a sudden, you've taken your housing wealth bucket, just like a 401k or an IRA, and you say, and people say, well, I've got equity. Don, I've got equity. I said, you can't buy a hamburger with equity. You can't pay a bill with equity, right? You can't. And the woman said to me, well, I'll just go over here to the bank. And I went to the second largest bank in the United States. We went online together, and I said, see right here, it says we're no longer offering home equity lines of credit.
Yeah.
I went to the largest bank in the United States online with the client. And I said, look here, we're no longer offering home equity lines of credit. So I said, so your equity sometimes may not be available nor accessible. And I asked her the question. I said, Mr. and Mrs. Jones, I said, knowing this, if you had a choice, would you rather your home's equity be liquid or locked? She said liquid.
Liquid.
I said, okay, knowing that, would you rather have that liquidity be growing or stagnant? Growing.
Mm-hmm.
I said, would you want to see how it works?
Yes.
And then I could show them, look at this $224,000. In 10 years it's this, in 20 years it's that. And I said, tell me some of the ways this could help you, just having access to this. Well, if my husband died, that could help replace some of that income. If his pension went away, listen, I went to buy a T-bone steak not too long ago, not the Piggly Wiggly, but Whole Foods, my wife's Whole Foods type girl. And I called her from the store. I wanted to get a bone-in ribeye. I don't normally buy the meat. And I called her. I said, did the cows go on strike? Has anyone bought a bone-in ribeye lately? Inflation. Now, who would have thought we'd be talking about inflation 8%, 8.5%? In some places, it's 10%.
Yeah.
And so that's eroding our money. But if you have a reserve, 250, 220, 185 in your housing wealth, and that's growing at 5% tax-free, we're not eliminating inflation, but that becomes the best thing you have in your arsenal, right? Because your CDs aren't paying that, your money market's not paying that, the money under the mattress is not paying that, most annuities are not paying that. So now you're just adding to that. So the strategic use starts with the concept, what could retirement be like if you were able to turn your locked equity into liquidity that's growing? And there are 42 strategies we could talk about. We won't, but you just think, oh, well, maybe I could do this. What about this? What about that? Now, the majority of people coming into retirement in America, the majority of people coming into retirement have a mortgage on their property, either mortgage, a second mortgage, a home equity loan, or home equity line of credit. The majority. And so in some places, it's 90%. I tell folks, do an informal survey. Just go somewhere where you know folks. Next barbecue over at Cousin Tracy's, there are 10 people who have homes, and just say, hey, anybody here have a mortgage, second mortgage, home equity loan, a line of credit? How many hands are going to go up? Every hand. And I don't know about you and Jerome. You got a mortgage?
Yep, we sure do.
I do as well. Everybody I know who's a homeowner. So what does that mean? That means you're coming into retirement 75, 80%, having a cash flow constraint because you've got to pay that monthly payment every month. You can't call up the bank and say, you know what, I don't feel well this month. I'm not sure I want to do this. So does nobody care about all that? Now, here's my question. You look at me, or I'll look in the camera here. Here's my question. Knowing this, that you all watching, you're already making a monthly loan payment, aren't you? You can't stop. I can't stop without consequence. So since you're already making this payment, if I'm curious, if you had a choice, would you rather that payment be mandatory or voluntary? What would you choose?
Voluntary.
Me too. Me too.
So you're saying that with this strategy, using the reverse mortgage, you would have the option to either continue to make a mortgage payment, or you could choose not to make a mortgage payment.
Well, listen, we just drew a triangle together and we put $250,000 in the middle of the triangle.
Right.
Now, let's say you've got a mortgage on your property and the balance is $50,000, or make it $200,000. So every month you're making a payment, $800, $1,200, $2,800 principal and interest payment. Whatever that number is, put a minus symbol underneath the triangle. And so let's say it's $200,000 and you're paying $2,000 a month principal and interest. What would retirement be like, Mr. and Mrs. Jones, Joyce and Jerome? What would retirement be like if you didn't have to make that $2,000 a month payment? Now, listen, you just heard me say that. You're watching this podcast. I want you to answer that question. Now, sometimes your clients are younger, right? And they say, well, I'm not 62. That's okay. You weren't hatched. So that means you got a mother, grandmother, big mama, nana, somebody, you got some aunts, you've got someone who's of age, owns a home, and they've got a mortgage. So everything is not to us, but a lot of things are going to come through us to be a blessing to others, right? So I want you're listening I want you to think of others. You sit next to them at church, on the bus, at family gathering. You sit next to them. So what would retirement be like if they didn't have to make a monthly loan payment? Sometimes I ask that question. I hear this, Joyce. I hear sound before I hear words. You listen.
I know. That's what I was thinking. Like, wow.
That's the sound of relief. Now, they say, well, Don, how could I do that? I said, you could use a home equity conversion mortgage, a reverse mortgage, and use the proceeds from a reverse mortgage to pay off your monthly mortgage payment, to pay off your loan. That frees up that money per month. That frees up that money. Now, what can you do with $800 or the $1,200 or $2,800 a month? Oh, gosh, I can draw less from my investments,
right?
Which makes them last longer. I could do more, sleep better, have more control, freedom, flexibility.
Take an extra vacation.
Sure, you can do all of that. And back to my original question. So, if you had a choice, would you rather your payment be mandatory or voluntary? Most people say voluntary. I say me too.
Yeah.
I said, why would you do it? You hear words like freedom, flexibility, control. The world's an uncertain place. Don't you wake up some mornings and wonder what happened overnight? What country blew up? Who invaded who? What's inflation? And the world's an uncertain place.
Yeah.
2.5 years ago, we couldn't spell pandemic. We couldn't spell it. But now we know it intimately, right? The world has changed. How do you prepare for that change? Would it be wise, if you had the choice, to take a mandatory payment and make it voluntary? So how does that work? You get a reverse mortgage, you eliminate your payment, but you eliminate the mandatory payment, but you can continue to make a payment. Now, why would I do that? Well, number one, your loan balance goes down, just like it does in a regular payment. But two, every time you pay that payment, or $1,000, $2,000 a month, it goes into the line of credit that's growing, and you could pull that money back out again anytime for any reason down the road without having to requalify or do anything else. So you've got access to your home's liquidity, and it's growing and you're managing it. So my question is, if the majority of people coming into retirement have a monthly loan payment of some sort, if they knew they could turn it from mandatory to voluntary, how many of them would say, no, I don't want to see how that works? Nobody would say that.
They wouldn't.
Nobody would say that. They would all say,
that's the part that I think that's the part that really kept my attention. And we've been sharing that with clients. You know, if you had a choice, would you want it to be mandatory or voluntary? All day voluntary.
Yeah. So,
guys, again, you're listening to Joyce Palmer, Proactive Women's Podcast. And we have a special guest here today, Don Graves, who shared a wealth of knowledge and information on how to utilize your housing wealth. He's the author of Retiree's Guide to Housing Wealth. And I'm going to have him share before we go out how you can get a copy of that book outside of coming to our office, because we keep copies there. They go fast, though. So we are talking about using not overlooking one of your biggest and best retirement assets. And my clients know that I am here and always available. They can call and ask me questions anytime. But I hear often that you have friends, family, coworkers, or people that just don't have a financial resource, a trusted person. Well, I extend myself to ask me any question. So if you're listening, you can call and ask any question about any financial matter. There's no cost, there's no obligation. It could be a question as simple as, when do I start taking Social Security? I hear that a lot. It could be a question about your 401k that you left at your old job. Or it could be a question about what we're talking about today. How do I utilize the equity in my home? How do I make that a part of my retirement assets that's working for me? And most importantly, how do I make that mortgage voluntary versus mandatory? So Dawn, as we close out, can you give my listeners the best way to get a hold of that book outside of coming to the office where we have copies, and also where they can hear more and learn more about the great work that you're doing?
Let me give it, yes. Housing Wealth, www.housingwealth.net, N-E-T, www.housingwealth.net will get you to me, and you can put in there contact Don, and my team will get to you. I want to give you something conceptual to think about, those who are listening, and you own a home. Do you know how much you're sitting on and liquid wealth? Do you know? Most people don't. You talked about an old 401k. I left a job, and it was all rolled over into an IRA. So I thought, and the old 401k, I got a letter that says, hey, what do you want us to do with this money you still have? Now, listen, folks, I didn't know I had money left. I thought it was some sort of scam. So I called the company. It's Principal Financial. They said, when you left such and such company, that got rolled over to us and you didn't do anything with it. I said, let me make sure it's not a scam. Who am I? They said, you're Don Graves, your social security number, this is your first dog's name, and all that. And once they convinced me that it was true, that I had money that I had left and I didn't know. You know what my first question was once I found out it was true? What do you think the first thing I asked them?
How much is it?
That's exactly what I said. I said, how much is it? How much is it? Oh, I'm embarrassed to tell you how much. I said, man, I'm not a rich man like that. I just walk away from it. It was good money. Now think about that. I was sitting on something that belonged to me that I could use. I didn't even know what was in there. Here's what I wanted to say to you. Find out how much you're sitting on in housing wealth, whether you use it or not. It becomes like an important document to say, you know how much is in your 401k or your IRA or your CDs or your money markets. You know how much is in there. Do you know how much is in your housing wealth? How much of your house can be made liquid? That's easy to do. You can talk to Joyce and Jerome. They know how to get that easily for you. It only takes them 2 minutes. But I don't want you to watch this podcast and say, oh, that was so interesting, but not find out. And if you do it through Joyce and Jerome, just call them. Call JP Financial and say, I'd like to know how much housing wealth I'm sitting on. So you won't hear from us. There's no pressure on me. I want you to have the information, because here's what I know. You're going to need every available asset to have a successful retirement. Why is that? Because you're going to live longer than your mom and daddy, most of us.
Right.
You haven't saved enough to sustain that longer life. And most of us are carrying some sort of debt, mortgage, home equity loans, maybe even consumer debt. You need access to everything. Don't allow your housing wealth to be there and you not know how to put it into practice. And so you talk to Joyce. And for books, you can go to Housing Wealth Book, www.housingwealthbook.com. You could see our books. But if you talk to Joyce,
I'll give you one.
I'll send you one for free. You don't have to do all that. You talk with Joyce. Listen, here's this. You say, Joyce, I want a housing wealth assessment. I just want to find out what I have, right? If you do that, and Joyce will get it, we'll send it to you for free. You have to be age 62 or older and a homeowner to do this. Is that fair enough? Is that fair?
That's fair enough.
That's fair. I may go out of business sending out all these books to your clients.
My listeners are good. They have been taking notes, and I promise you, I've already heard some bells ringing, so the phone will definitely be ringing.
Let me say this, Joyce. 22 years I've done this, and I'm certainly passionate about it. In my 22 years, I've had 16,000 consumer-facing conversations, and 3,000 people have gone forward to become my clients.
Awesome.
But listen, all that tells you is that as good as reverse mortgages are for many, they're not always the right thing to do. I've told more people this is not for you than I've told them this is for you. Right. Get the education, learn what it is. And if it makes sense, Joyce and Jerome will be your bearer and your buffer. But I think you'll be pleasantly surprised. So talk with them. Allow me to send you a free book with the assessment. Okay, that's all I got to say.
Thank you, guys. And again, this is Joyce Palmer with the Proactive Women Podcast. Stay tuned for our next series, our next episode coming to you soon.
Thank you for listening to Proactive Women, helping create financial legacies for ladies. Oh, and men too. Be sure to visit jpfinancialgroupllc.com. Call Joyce at 704-543-6269 or email Joyce at jpfinancialgroupllc.com. You can find us on all your favorite platforms. Be sure to subscribe to hear more proactive wisdom on wealth from Joyce Palmer and JP Financial Group.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.